All right, get ready to dive into some numbers. Nubank's parent company, New Holdings, just released their Q4 2024 earnings.
It's a pretty wild story. Explosive growth and some seriously ambitious plans. Like, they're not just trying to be another bank. They want to be like the whole financial ecosystem.
Yeah, and everyone's kind of watching how they're managing all this crazy growth, especially with, the economic climate in Brazil being a little shaky.
It's a bit of a tightrope walk for sure.
Definitely. First off, the numbers. They added how many customers last year? A whopping 20.4 million.
Yeah, bringing their total customer base to 114.2 million. To put that into perspective, we're talking over half of Brazil's population.
Incredible, right?
And it's not just quantity, it's about engagement too. So their active customer base. That also saw a huge jump. Nearly 95 million people are using their services regularly.
It's that stickiness that really shows their power.
Yeah, exactly. And they're not just growing, they're making money. Their net income basically doubled to almost $2 billion. And get this, a return on equity of 28%.
Wow, those are some serious numbers.
They're quickly becoming one of the most profitable financial institutions, like globally.
And, we've got to talk about their low-cost model. It's clearly working.
Oh, absolutely. Keeping expenses down while they're scaling so rapidly, that's key. And this is where all that focus on technology and efficient processes really shines.
So let's get into some of their strategic moves.
Yeah.
Because honestly, that's where things get super interesting.
Right.
Mexico, first. They blew past the 10 million customer mark there.
Yeah, proving this model isn't just a Brazil thing. It's working south of the border, too.
And then secured lending. Hold on to your hats.
Because their secured lending portfolio shot up by, get this, 615%.
That's not just growth. That's insane.
It's crazy, right?
What's driving this? I mean, they're tapping into a huge market with things like payroll loans and other secured options.
Exactly. It's all about smart plays in a risky economic environment. Secured loans, way less risky, especially if things get bumpy,
They're not just going after the average customer either. They're winning over wealthy clients.
Yeah.
Their Ultravioleta product.
Ultravioleta.
132% increase in customers and a net promoter score, get this, 84.
Yeah, they're not just about disruption. They're going after different parts of the market. It's a sign of their ambition. They want to be the full package.
And they're pushing beyond just banking, too.
Right.
They're building this whole ecosystem with travel booking, a marketplace, even a mobile network.
It's all about becoming that comprehensive financial partner. They want to be woven into every part of their customers' lives.
So let's talk about the elephant in the room, the Brazilian economy.
Yeah.
Inflation is a concern. The overall economic outlook is a bit shaky. Not exactly the best environment.
Right, but how Nu's responding is worth paying attention to. They're not afraid to lend, but they are being cautious.
And they've got experience with economic downturns in Latin America, right? They've weathered storms before.
Exactly. It's like they're saying, we've seen this movie, we know how it ends. And their decision with the Pix financing product, that says a lot.
Yeah, they hit the pause button on expanding that too aggressively. It's profitable, but...
They're putting the long game first. The health of their customer relationships is more important than a quick win. It's about building trust, building loyalty.
Exactly. They're in it for the long haul.
Right.
Now let's zoom in on something specific. Their credit card portfolio. There's some interesting things going on there.
Yeah, so their interest-earning installments, they're growing every quarter, but the overall share of those installments, it actually dropped to 27%. There's a story there.
Didn't they mention that this is all tied to, the Pix financing product, the one they're being careful with?
Exactly. Pix financing. Super strong demand, good profits, but they're being cautious, making sure it doesn't backfire.
So they're making sure it doesn't mess up customer engagement, their relationships with their clients. It's all about sustainable growth, not just chasing quick money.
They're watching it closely, fine-tuning, making sure it doesn't hurt things down the line.
What I find interesting is all their secured lending originations are coming straight from their own platform. They're not buying up loan portfolios.
It's all organic growth. They're relying on their own brand, their own way of bringing in customers.
And those FGTS-backed loans, over 60% of their secured lending is coming from there. They're crushing it.
They've got a market share of over 30% for new originations. It shows how powerful their digital distribution is. Reaching customers directly, no middleman.
Okay, let's talk funding. Their total deposits for the quarter, they jumped to $28.9 billion.
Yeah.
That's 55% growth year over year.
They're like a magnet for cash right now. Their deposit strategy, especially in Mexico and Colombia, it's working.
Yeah.
Competitive rates, a smooth digital experience. Customers are loving it.
And even after they reduced the spread over the interbank rate, their operations in Mexico, they pulled in $4.5 billion in deposits.
4 times what they had last year. That's incredible.
It really shows how they're able to boost cross-selling while making their unit economics better. More customers using more of their products, making more money. Win-win.
Yeah, in Colombia, that's impressive too. They hit $1.3 billion in deposits, and they only launched their checking accounts there 2 quarters ago.
That puts them in the top 5 financial institutions in Colombia, just based on demand deposits for individuals. They're a force to be reckoned with.
Absolutely.
All right, bottom line, net interest income. What are we looking at?
Big jump. 57% year over year, hit a record $1.7 billion.
But their net interest margin contracted by 70 basis points, right?
Yeah.
Down to 17.7%.
That's true. That's mainly because of lower credit yields. It comes with relying more on those secured loans. They usually have lower interest rates. It's the trade-off.
And their funding costs went up a bit too because of all that deposit growth in Mexico and Colombia.
Right. The price of expanding, bringing in new customers. And we can't forget currency fluctuations. Those had an impact on the margin too.
So how are they planning to boost their net interest margins moving forward?
They're betting on optimizing their balance sheet. And they think as those deposits in Mexico and Colombia normalize, that'll help too.
Their loan-to-deposit ratio is still pretty low, so they've got room to maneuver.
Oh yeah, they're definitely seeing opportunities to squeeze out more efficiency and push profitability even higher.
All right, cost management. Keeping expenses under control is huge, especially when they're growing this fast.
They've kept their cost per active customer down to $0.08.
That's amazingly lean, especially compared to those traditional banks. It's a huge advantage.
Now, just to be clear, on an FX neutral basis, that cost actually went up 11% year over year.
Okay, so it did go up a bit. Why?
It's mostly because of those seasonal spikes in data and processing usage, typical for Q4.
It's not a big deal, just a temporary thing.
Exactly.
But if costs went up, how are they still so profitable?
Because their average revenue per active customer, that grew by 23% in the same period.
So they're making more money per customer, which covers the higher costs. That's smart.
Their business model is built to scale. As they grow, their technology and automation help them handle those costs without killing their profit.
It's like a well-oiled machine that just keeps humming along. Speaking of profitability, their gross profit for the quarter, it hit $1.4 billion.
That's an 8% sequential increase and 44% jump from last year.
Wow.
And both of those are adjusted for currency fluctuations. It really shows how strong their model is.
And gross profit margins.
They bounced back close to 2023 levels at 45.6%. Pretty impressive considering the higher funding costs they've got in those new markets.
Definitely. Okay, let's talk about those non-performing loan trends. Always important to keep an eye on that, especially when the economy is a bit uncertain.
Absolutely. It's like checking the pulse. And the good news, their 15 to 90 NPL ratio, which is a key indicator, it actually went down 30 basis points to 4.1% for the quarter.
That's good news. It shows their risk management is working. But what's driving that improvement?
Well, there's the normal seasonal decrease in those early delinquencies that tends to happen in Q4, but also their move towards bringing in lower risk customers for credit cards and that focus on secured lending, that's helping too.
So they're being pickier about who they lend to and focusing on products that are inherently less risky. Makes sense.
Yeah, all about mitigating risk, especially when things are unpredictable.
What about their 90-plus NPLs, those loans that have been delinquent for a while?
Those went down too, dropped 20 basis points down to 7%.
So both their short-term and long-term delinquency rates are improving.
Good signs for their credit quality.
Now, I'm curious about their approach to renegotiated loans. They mentioned something about reaching out to customers proactively before their loans even become delinquent.
Right. They try to step in early, often before loans are even 15 days overdue. It's about helping those customers get back on track, avoid falling further behind.
It's almost like they're acting as financial coaches.
Exactly. It benefits everyone. No reduces their risk. Customers manage their finances better.
And it goes back to that whole idea of building those long-term relationships.
Absolutely. They're not just in it for a quick buck. They're in it for the long haul.
Okay, let's dig into secured lending in Brazil. They're doing incredibly well there, especially with those payroll loans.
Yeah, their secured lending portfolio, remember, it grew by a crazy 615% year over year. It hit $1.4 billion.
It's mind-boggling how fast they're growing.
Right.
What's driving that? They've partnered with 9 new collateral counterparties, in the public sector.
Smart move.
Yeah.
That gives them access to a huge pool of potential borrowers.
So they're going after government employees, public sector workers.
Exactly. It means their addressable market for payroll loans is now a whopping 70% of the whole segment.
Wow. Think about it. 12 million of their existing customers are now eligible for those payroll loans, plus another 80 million potential borrowers for FGTS loans. Those are some serious numbers.
It's a huge opportunity, and they're grabbing it with both hands.
And they've been working on making their portability solution even better, making it easier for customers to bring their loans over from other places.
Yeah, as of December 2024, 16% of their INSS originations were from customers who ported their loans to Nubank. They're often refinancing at better rates, too.
So they're not just getting new customers, they're luring in those who already have these loans.
They're offering a better deal, customers are taking notice, and don't forget, their market share in those FGTS originations, it's already over 30%.
It's incredible.
It really shows they found a winning formula. Their digital distribution model is a big part of that.
So much more efficient than those old school lenders.
Right.
And they've reached product parity in secured lending. They now offer the same features and benefits for public payroll loans as all the big players.
Portability, top-ups, refinancing, the whole package. It's about giving customers options, meeting their needs.
They're not just offering a product, they're offering a solution.
Exactly.
And their recent integration with Brazil's armed forces, that's a big step too. Opens up a whole new segment of borrowers.
It's another sign they're strategically building a dominant position in this market. They're playing the long game, and so far, they're winning.
Now, Mexico, another big piece of their growth puzzle.
Huge milestone there. They passed 10 million customers in Mexico. That's a 91% increase year over year.
They're on fire.
Right.
What's driving that?
Well, they're now serving 12% of the country's adult population. That's serious penetration. Their brand, their products, they're clearly resonating with Mexican consumers.
And their deposits in Mexico, those have skyrocketed too.
Oh, yeah. Up by 438% from last year, hitting $4.5 billion.
It shows they're building trust. Mexican consumers are feeling confident putting their money with New.
Absolutely. They're becoming a trusted name.
And their credit card customer base in Mexico, that's grown too, hasn't it?
Yep, 70% growth. They're up to 5.6 million credit card customers now.
A lot of new cards out there. What's interesting about that growth, though?
Almost half of those new customers, they didn't have a credit card before Numa. So they're not just taking customers from other banks. They're bringing new people into the credit card world.
Promoting financial inclusion.
Exactly. And they're doing it responsibly. Their risk management is working. Their first payment default rate has improved by about 50% over the past 3 years.
So they're getting even better at figuring out who to lend to.
Right. And at the same time, their credit approval rates have actually gone up by 10%.
So they're finding that balance. Growing while lending responsibly, not an easy thing to do.
Nope, not at all.
And their physical presence in Mexico, they're expanding that too, aren't they?
Yeah, strategically expanding cash in and cash out access. They've got over 30,000 contact points across Mexico now.
So they're blending that digital strength with a real-world network. Smart.
It's about convenience, accessibility, giving their customers what they need.
They're really taking that Brazilian playbook and running with it in Mexico.
They're adapting it, tweaking it for the local market, and so far, it seems to be working.
Okay, Colombia.
Colombia's exceeding expectations. They've reached $1.3 billion in deposits.
Wow.
That puts them in the top 5 in Colombia, just based on demand deposits for individuals. And remember, they launched their checking account there just 2 quarters ago.
That's incredible.
They're leveraging their expertise, their experience to make some serious waves in Colombia. They're a company to watch for sure.
Okay, let's get serious for a minute. Risk management. Crucial for any financial institution, especially with everything going on in Brazil.
Yeah, inflation worries, a potential economic roller coaster, it's all on investors' minds. But New's approach is pretty interesting. They're not downplaying the risks.
They're not sugarcoating it.
Nope. They're being proactive, stress testing their models, even running those worst-case economic scenarios. They're preparing for the possibility of a downturn,
They're not just assuming it's going to be smooth sailing.
Exactly. They're being realistic, being cautious. And that cautious approach, you see it again in their decision to pause the aggressive expansion of their PIX financing product.
Yeah, I mean, that product's been profitable.
Right. But they're focused on the long game, making sure it doesn't have a negative impact, on customer engagement, loyalty, all that.
They're not just chasing quick profits. They're thinking about the bigger picture.
They're playing chess, not checkers.
I like that. All right, let's dive into their credit card portfolio in Brazil a bit more. We've talked about the growth, but there are some interesting things happening under the hood.
Yeah, you've got those interest earning installments. They're growing every quarter, but the overall share of those installments, it actually went down to 27%
It's a bit of a head scratcher. Why would the share decrease if the installments are growing?
because they're tapping the brakes on that PIX financing, especially for certain risk groups.
So they're making sure that PIX financing doesn't end up hurting their overall credit card business or their relationship with their customers.
Exactly. They're managing it carefully, making sure it doesn't backfire.
It's all about being smart,
Mm,
thinking long term.
right.
And one thing that really stands out, all of their secured lending originations, they're all organic. They're not out there buying loan portfolios from other companies.
They're building it themselves. It shows confidence in their own brand, their own ability to attract borrowers.
And those FGTS-backed loans, they're a huge part of their secured lending business, right?
More than 60% of their originations are coming from that product.
They've got over 30% market share for new originations. That fully digital distribution model is really working for them.
It's efficient, it's effective, they're reaching a lot of people.
Now funding. Total deposits for the quarter, they jumped to $28.9 billion. That's a 55% year-on-year increase.
They're attracting deposits like crazy. Their deposit strategy, especially in Mexico and Colombia, it's working. Competitive rates, easy to use platform, customers are happy.
Even after they lowered the spread over the interbank rate, their Mexico operation brought in $4.5 billion in deposits.
Yeah, 4 times what they had last year.
It's impressive. It shows how they're able to increase cross-selling and make their unit economics better.
They're getting more customers, those customers are using more of their products, and that leads to more money. Everybody wins.
And Colombia, let's not forget about Colombia, $1.3 billion in deposits just 2 quarters after they launched checking accounts there.
That's remarkable.
It puts them among the top 5 financial institutions in Colombia just based on those individual demand deposits.
They're a force to be reckoned with. They're proving they can replicate their success. It's not just a Brazil thing.
All right, bottom line, net interest income. What are we looking at?
Up 57% year over year. Hit a record $1.7 billion.
But their net interest margin, it contracted by 70 basis points, down to 17.7%. Why is that?
A few reasons. The bigger focus on secured loans, those typically have lower interest rates. So that puts some pressure on their overall credit yields.
So it's a bit of a balancing act. Growth versus profitability.
Right. And then you've got the higher funding costs. That's because of all that deposit growth in Mexico and Colombia. And we can't forget those currency swings, they have an impact too.
So what's the plan to improve those margins going forward?
Balance sheet optimization, that's their key focus. And they think things will improve as those deposits in Mexico and Colombia normalize a bit.
They've got some breathing room with that loan to deposit ratio still being relatively low.
Yeah, lots of opportunity to improve efficiency, push that profitability even higher.
Let's talk about costs. Managing those is crucial, especially when you're growing as fast as new.
They've been able to keep their cost per active customer down to 80 cents.
That's crazy low. It's going to be a huge advantage compared to traditional banks.
It is. But on an FX neutral basis, that cost actually went up 11% year over year.
So it did increase. Why is that?
Mostly seasonal stuff. Those spikes in data and processing usage, you usually see that in Q4.
So nothing to worry about, just a temporary blip.
Exactly. And their average revenue per active customer, or ARPAC, that grew by 23% over the same period.
So more revenue per customer, more than making up for the higher costs.
Right. Their model is all about scaling efficiently. As they grow, their tech, their automation, it all helps them handle those costs without sacrificing profitability.
Okay, let's look at their gross profit for the quarter. It hit $1.4 billion.
That's an 8% increase from the previous quarter and a 44% jump from last year.
Those are impressive numbers.
Both of those figures, by the way, are adjusted for currency fluctuations. It shows how strong their business model really is. Consistently profitable, even while they're expanding into new markets and investing heavily.
And their gross profit margins.
They bounced back almost to 2023 levels, 45.6%. And that's with those higher funding costs in their newer markets.
It's a sign they're managing things well, balancing growth with profitability.
Exactly. They're not just growing for the sake of growth, they're doing it in a way that makes financial sense.
Now, let's talk about those non-performing loan trends. Always important to keep an eye on those, especially in a potentially shaky economic environment.
Absolutely. It's like taking the temperature of their loan portfolio. Their 15 to 90 NPL ratio, that's a key early warning sign, it actually decreased by 30 basis points in the quarter. down to 4.1%.
Okay, so that's good. What's driving that improvement?
Well, there's the usual seasonal decrease in early delinquencies you see in Q4, but they're also benefiting from that strategic shift toward those lower risk customers for credit cards and the bigger focus on secured lending that helps too.
So being more selective about who they lend to and focusing on those less risky products, it's paying off.
Yep, it's all about managing risk.
What about their 90-plus MPLs, those loans that have been delinquent for a longer period?
Those went down too, by 20 basis points to 7%.
So both their short-term and long-term delinquency rates are looking better.
Positive signs for their overall credit quality.
Now, I'm curious about their approach to those renegotiated loans. They talked about proactively reaching out to customers even before the loans become delinquent.
Right. They intervene early, often before a loan's even 15 days overdue. They want to help those customers get back on track, prevent them from falling further behind.
It's a really customer-centric approach.
It is. And it helps everyone. It lowers news risk, helps those customers manage their finances better.
And it fits with their whole philosophy of building those long-term relationships.
Absolutely.
Okay, let's dive deeper into their secured lending business in Brazil, specifically those payroll loans.
They are crushing it there. Their secured lending portfolio grew by a mind-blowing 615% year over year, hit $1.4 billion.
It's incredible.
Right.
What's behind that growth? Well, they've partnered with 9 new collateral counterparties in the public sector.
Smart move. It gives them access to a massive pool of potential borrowers.
Government employees, public sector workers.
Jesus. It means their addressable market for payroll loans has jumped to 70% of the whole segment.
Wow. Think about that. 12 million of their existing customers are now eligible for those payroll loans. Plus, you've got another 80 million potential borrowers for those FGTS loans.
It's a massive opportunity, and they're making the most of it. They've also been working on making their portability solution even better, so customers can easily switch their loans over to Nubank.
So they're not just attracting new borrowers, they're also trying to pull in those who already have loans with other institutions.
Exactly. And as of December 2024, 16% of their INSS originations came from customers who ported their loans to Nubank. Often, they're refinancing at better rates, too.
So they're giving those customers a better deal, and people are taking notice.
Right. And their market share in those FGTS originations, it's already over 30%. They've found a winning formula. That fully digital distribution model is a big part of their success.
So much more efficient than those traditional lenders.
And they've also reached product parity in secured lending. They now offer the same features and benefits for public payroll loans in Brazil that the big players do. Portability, top-ups, refinancing, the whole 9 yards.
So they're giving customers options, meeting their needs.
Exactly. And their recent integration with Brazil's armed forces, that's another big step, opening up a whole new segment of borrowers for them.
It's all part of a very strategic plan to become a dominant force in this market. And so far, they're doing a great job.
They're playing the long game.
Now, let's turn our attention to Mexico, another key piece of their growth strategy.
They've hit a major milestone there, surpassing 10 million customers. That's a 91% increase year over year.
Impressive.
Right. Their penetration in the Mexican market is remarkable. They're now serving 12% of the country's adult population. Their brand, their products, they're clearly resonating with Mexican consumers.
And their deposits in Mexico, those have skyrocketed.
Oh yeah, up 438% from the previous year, hitting $4.5 billion.
That's a massive jump. It shows they're building trust, they're building a reputation. Mexican consumers are feeling good about putting their money with Noon.
Exactly.
And their credit card customer base in Mexico, that's growing rapidly too.
Up 70% year over year. They've got 5.6 million credit card customers there now.
A lot of new cards out there. What's particularly interesting is that almost half of those new credit card customers, they didn't have a credit card before joining Noon.
Right. So they're not just taking customers away from other banks. They're bringing new people into the credit card market, promoting financial inclusion.
A really positive impact.
And
they're doing it responsibly. Their risk management is working. They've improved their first payment default rate by about 50% over the past 3 years.
And at the same time, they've actually increased their credit approval rates by 10%. So they're finding that balance between managing risk and expanding access to credit.
Not easy to do.
Not at all.
And there's physical presence in Mexico. They're expanding that strategically too, aren't they?
Yeah, they've expanded their cash-in and cash-out access to over 30,000 contact points across Mexico. It's all about convenience, about making their services easily accessible.
They're blending that digital strength with a real-world network.
Exactly. They're adapting their Brazilian playbook to the Mexican market, and it seems to be working.
All right, let's talk about Colombia. Their performance there has been exceptional.
Their deposits in Colombia, they've reached $1.3 billion. That puts them among the top 5 financial institutions in the country based on demand deposits for individuals.
And they did that in just 2 quarters after launching their checking account there.
It's remarkable. It really shows the strength of their brand and the demand for their services. They're proving that they can replicate their success in new markets.
Now let's shift gears and talk about risk management. This is crucial for any financial institution, but especially now with all the concerns about inflation and the economic outlook in Brazil.
Yeah, those concerns are definitely top of mind for investors. How's New approaching this?
Well, they're not ignoring the risks. They're not pretending everything's fine.
Nope. They're being proactive, stress testing their models, even running those worst-case economic scenarios. They're preparing for the possibility of a downturn.
So they're not just assuming it's going to be smooth sailing. They're being realistic.
They're being cautious. And that cautious approach is really evident in their decision to hit the pause button on the aggressive expansion of their PIX financing product.
That's a product that's been profitable for them, so it's an interesting decision.
Right. But it's all about the long game, making sure that product doesn't end up hurting those customer relationships, doesn't damage their brand reputation. They're thinking about the bigger picture.
So not just chasing short-term profits.
Exactly.
Now, let's dive a bit deeper into Nu's credit card portfolio in Brazil. We've talked about the overall growth, but there's some interesting trends happening there. Expert speaker.
Yeah, their interest-earning installments, they grew every quarter, but the overall share of those installments actually went down to 27%. It's a little counterintuitive.
Yeah, it does seem a bit strange. Why would the share decrease if the installments are growing?
It's mostly because they decided to slow down how much they're expanding PIX financing, especially for some of those riskier groups. They're being careful about how they manage this.
So they're making sure this PIX financing thing doesn't mess up their overall credit card portfolio or their relationships with the customers in the long run.
Right. They're keeping a close eye on it, making adjustments if they need to. It's a bit of a balancing act, but they're handling it well.
It's interesting that all of their secured lending originations are coming directly from their own platform. They're not going out and buying up loan portfolios from other companies.
It's all organic growth, relying on their own brand and their ability to attract customers. That's pretty impressive.
And their FGTS-backed loans, those are a big winner for them.
Definitely. Over 60% of their secured lending originations are coming from that one product. They really understand the Brazilian market.
They've got over 30% market share for new originations. That fully digital distribution model is really working for them.
It's efficient, effective, reaching a lot of customers.
Let's talk about funding for a minute. Total deposits for the quarter jumped to $28.9 billion. That's a 55% increase year on year.
Yeah, they're pulling in deposits like crazy. Their strategy, especially in Mexico and Colombia, is working really well. Competitive rates, easy to use platform. It's a hit with customers.
Even after they lowered the spread over that interbank rate, their Mexico operations still brought in $4.5 billion in deposits.
4 times what they had a year ago.
It shows they're really good at increasing cross-selling and improving their unit economics. More customers using more products, and that means more money.
Exactly. It's a win-win situation. And Colombia is another great example. They hit $1.3 billion in deposits just 2 quarters after launching checking accounts there.
That's remarkable.
It really is. They're proving they can replicate their success in new markets. It's not just a Brazil story anymore.
All right, let's talk profitability. Net interest income jumped 57% year over year to a record $1.7 billion.
It's a sign of their strong growth trajectory and the effectiveness of their business model.
But their net interest margin did contract by 70 basis points, down to 17.7%. What's causing that?
A few things are at play. Their growing focus on secured loans is one factor. Those loans typically have lower interest rates. So that puts some downward pressure on their overall credit yields.
So they're kind of choosing between growth and profitability in a way.
Yeah.
They're going for those lower risk loans, which might have slightly lower returns right now.
Exactly. And then you've got the higher funding costs from all that deposit growth in Mexico and Colombia.
Yeah.
It's part of expanding into new markets.
And of course, we can't forget about those currency fluctuations.
Those always add a layer of complexity.
So what's the plan to improve those margins going forward?
They're banking on balance sheet optimization, And they expect things to look better as those deposits in Mexico and Colombia normalize a bit.
They've also got some room to maneuver with their loan-to-deposit ratio still being pretty low.
Yeah, they've got opportunities to squeeze out more efficiency and really push that profitability higher.
All right, let's switch gears and talk about cost management. Keeping expenses under control is obviously crucial, especially with how fast they're growing.
They've managed to keep their cost per active customer down to just 80 cents.
That's incredibly low, especially compared to traditional banks. It has to be a big advantage for them.
It definitely is. But keep in mind, on an FX neutral basis, that cost actually went up 11% year over year.
Oh, so there's an increase. Why is that?
It's mostly because of those typical seasonal spikes in data and processing usage. You tend to see that in Q4.
So it's not a sign of any underlying problems with their efficiency, just a temporary thing.
Exactly. And to counter that, their average revenue per active customer, or ARPAC, grew by 23% in that same period.
So they're making more money from each customer, which more than covers those higher costs.
That's the beauty of their business model. It's designed to scale efficiently. They can grow and manage those costs without sacrificing profitability.
It's a well-oiled machine. Speaking of profitability, their gross profit this quarter hit $1.4 billion.
That's an 8% sequential increase, and a whopping 44% jump compared to last year. Both of those figures are adjusted for currency fluctuations, by the way.
So those are some solid numbers.
They really show how strong their business model is. They're consistently profitable, even while they're expanding and investing heavily in new markets.
And their gross profit margins.
They're back up close to 2023 levels, 45.6%. That's even with those higher funding costs they have in their newer markets.
It's a sign they're managing that balancing act between growth and profitability really well.
Absolutely. They're not just growing for the sake of it, they're doing it in a way that makes financial sense.
Okay, let's take a look at those non-performing loan trends. Always important to keep an eye on those, especially in a potentially uncertain economic environment.
Right, it's like checking the health of their loan portfolio. Their 15 to 90 NPL ratio, which is a key leading indicator, actually went down to 4.1% in the quarter.
So that's a good sign. It seems like their efforts to manage risk are working. What's driving that improvement?
Well, there's that typical seasonal decrease in early delinquencies that you see in Q4 plus. Their move towards attracting those lower risk customers for credit cards and the increasing proportion of secured lending, that's helping too.
So they're being more careful about who they lend to, and they're leaning more on those less risky products. It's a smart strategy.
It is. And their 90 plus NPLs, those loans that have been delinquent for a longer time, those decreased as well, down to 7%.
So both their short-term and long-term delinquency rates are improving. That's good news for their overall credit quality.
Absolutely. And it suggests that their underwriting practices and their approach to risk management are working well.
Their proactive approach to those renegotiated loans, where they often intervene even before a loan becomes 15 days overdue, is another example of how they're managing risk effectively.
Right. It's a very customer-centric approach. It aims to help borrowers get back on track early on before those problems get any worse.
It reduces the chance of delinquency for new, while also giving those customers some valuable support.
It's a win-win. And their provision coverage level for that renegotiated portfolio, it's over 200%. It shows they're being prudent and responsible.
Now, let's talk about something exciting. Secured lending in Brazil. They are killing it in this area, especially with those payroll loans.
Their secured lending portfolio grew by a mind-blowing 615% year over year, reaching $1.4 billion. That's a significant 23% of their total lending portfolio.
It's phenomenal growth.
It is. They've been very strategic. They've partnered with 9 new collateral counterparties in the public sector.
Smart move. Gives them access to a huge pool of potential borrowers.
Exactly. And it expands their addressable market for those payroll loans to 70% of the whole segment.
Wow, 12 million of their existing customers are now eligible for those payroll loans. Plus, there are another 80 million potential borrowers out there for FGTS loans. It's a massive opportunity.
It really is, and they're going after it. They've also been busy making it easier for customers to switch their loans to Nubank by improving their portability solution.
So they're not just attracting new borrowers. They're pulling in customers who already have loans with other institutions.
Exactly. As of December 2024, 16% of their INSS originations came from customers who moved their loans over to Nubank, often refinancing at more favorable terms.
They're offering a better deal, and customers are responding.
Right. And don't forget, their market share in those FGTS originations, it's already over 30%.
Their fully digital model is really paying off.
It is. They're reaching a broad customer base efficiently and cost effectively.
They've also achieved product parity in secured lending, offering the same features and benefits for public payroll loans in Brazil as those bigger, more traditional players.
They're not just keeping up, they're setting the pace.
And that integration with Brazil's armed forces, that's another big step for them.
It opens up a whole new segment of potential borrowers.
It's all part of a very strategic plan to dominate the Brazilian secured lending market. And so far, they're doing a fantastic job.
They're executing their strategy effectively.
Now let's switch gears and talk about their performance in Mexico, another crucial market for them.
They've already surpassed 10 million customers in Mexico, a 91% increase year over year. Their penetration is impressive. They're now serving 12% of the country's adult population.
They're making their mark south of the border.
They are. And their deposits in Mexico have grown significantly as well, surging by 438% from the previous year to $4.5 billion.
That's a huge vote of confidence from Mexican consumers.
It shows they're building trust and establishing themselves as a reliable financial institution in the Mexican market.
Their credit card customer base in Mexico has also expanded rapidly, growing by 70% to 5.6 million.
What's particularly impressive is that nearly half of those new credit card customers didn't have a credit card before joining Newcost. They're bringing new people into the formal financial system.
That's a real win for financial inclusion.
It is. And they're managing this growth responsibly. Their first payment default rate has improved by about 50% over the past 3 years, while their credit approval rates have actually gone up by 10%.
So they're finding that sweet spot between expanding access to credit and carefully managing risk.
They're walking that tightrope skillfully.
Their strategic expansion of cash-in and cash-out access to over 30,000 contact points across Mexico makes their services even more convenient and accessible.
They're blending their digital capabilities with a physical presence to meet the needs of their diverse customer base.
It seems like they're successfully applying their Brazilian playbook to the Mexican market, adapting it as needed.
They're showing they can succeed in different environments.
Now let's turn our attention to Colombia, where news performance has been nothing short of exceptional.
Their deposits have reached an impressive $1.3 billion, placing them among the top 5 financial institutions in Colombia based on demand deposits for individuals.
And remember, they only launched their checking account there 2 quarters ago.
It's been a rapid ascent. It highlights the strong demand for their digital banking services in the Colombian market.
They're proving they can scale quickly and effectively. Now, let's dive into a crucial aspect of their strategy: managing risk, especially in the context of Brazil's economic outlook.
Yeah, there are those concerns about inflation and a potentially volatile economy. It's a challenge for any financial institution. But New's approach is proactive and multifaceted.
They're not shying away from those potential headwinds.
Not at all. They're acknowledging the risks and taking steps to mitigate them.
Their decision to pause the aggressive expansion of their Pix financing product is a good example of their cautious approach.
It's a profitable product, but they're prioritizing the long-term health of their customer relationships and their brand reputation. They're not just chasing short-term gains.
It's a sign of a company that's thinking strategically and playing the long game.
Exactly. They understand that trust and loyalty are essential, especially in uncertain times.
Now let's take a closer look at New's credit card portfolio in Brazil. We've already discussed their impressive growth, but there are a few interesting details worth exploring.
Yeah, their interest-earning installments have been growing every quarter, but the overall share of those installments actually decreased to 27%. It might seem counterintuitive, but there's a reason for that.
It does seem a bit odd. Why would the share decrease, even though the installments are growing?
It's mainly because of their deliberate decision to slow down the expansion of Pix financing, especially for certain risk segments. They're being very careful and strategic about how they manage this product.
So they're making sure it doesn't negatively impact their overall credit card portfolio or their long-term relationship with their customers.
Exactly. They're monitoring its performance closely, making adjustments as needed. It's a balancing act, but they're doing a good job of managing it.
Another impressive aspect of their lending operation is that all their secured lending originations are organic. They're not going out and buying loan portfolios from other companies.
That's right. They're building this part of their business from the ground up, relying on their brand strength and their ability to attract customers on their own.
And their strategic focus on FGTS-backed loans is clearly paying off.
More than 60% of their secured lending originations come from that product. It shows how well they understand the Brazilian market.
They've got over 30% market share for new originations. That fully digital distribution model is really working for them.
It's a powerful engine for growth, allowing them to reach a wide audience quickly and efficiently.
Now, let's shift our focus to their funding strategy. Their total deposits for the quarter surged to $28.9 billion, representing a robust 55% year-on-year growth. They're attracting deposits at an incredible pace.
Their deposit strategy, particularly in Mexico and Colombia, is a big reason for that success. They're offering competitive rates and a user-friendly digital experience.
Even after reducing the spread over the interbank rate, they still managed to pull in $4.5 billion in deposits in Mexico. That's 4 times what they had last year.
It shows how strong their brand is becoming and the increasing trust they're building with consumers.
And in Colombia, they reached $1.3 billion in deposits just 2 quarters after launching their checking account there.
They're gaining momentum quickly in the Colombian market. It's another sign that their model is adaptable and can be replicated successfully in different countries.
Now let's dive into their profitability metrics, starting with their net interest income. It jumped by a remarkable 57% year over year, reaching a record $1.7 billion.
That's a clear indication of their strong growth and the effectiveness of their business model.
However, their net interest margin contracted by 70 basis points down to 17.7%. What's causing that contraction?
Several factors are contributing to that. Firstly, their increasing reliance on secured loans, which tend to have lower interest rates, is putting some downward pressure on their overall credit yields.
This is a bit of a trade-off between growth and profitability, at least in the short term.
That's right. And their funding costs have also increased due to the significant growth in deposits, particularly in Mexico and Colombia. It's the natural result of expanding into new markets.
It's a balancing act.
It is. And of course, we can't forget about the impact of currency fluctuations. Those always add a layer of complexity.
So how do they plan to tackle this margin compression going forward?
They believe that optimizing their balance sheet will be crucial, and they expect to see improvements as those deposits in Mexico and Colombia normalize a bit.
Their relatively low loan-to-deposit ratio also gives them some flexibility to improve their efficiency and drive profitability higher.
They're constantly evaluating and adjusting their strategies.
Now let's shift our attention to their cost management, which is a critical element of their success. They've managed to maintain an impressively low cost to serve per active customer of 80 cents.
That's significantly lower than many traditional banks. It gives them a real competitive edge.
But on an FX neutral basis, that cost actually went up 11% year over year. Why is that?
That increase is primarily attributed to the usual seasonal spikes in data and processing usage that you typically see in Q4. It's a temporary fluctuation rather than a sign of any fundamental problems.
So their underlying efficiency remains strong.
Exactly. And their average revenue per active customer, ARPAC, grew by a healthy 23% over the same period, more than making up for those increased costs.
Their business model is built to scale. That's clear.
It is. They're investing heavily in technology and automation to ensure that their platform can handle their rapid growth without sacrificing profitability.
Their gross profit performance also demonstrates their ability to balance growth with profitability. They achieved a gross profit of $1.4 billion this quarter, an 8% sequential increase, and a 44% jump from the previous year.
Both those figures are adjusted for currency fluctuations, highlighting the underlying strength of their business.
And their gross profit margins bounced back to 45.6%, close to 2023 levels, even with those higher funding costs they're facing in their newer markets.
It shows they're managing their growth effectively and maintaining healthy profitability.
Now let's take a look at their non-performing loan trends. Their 15 to 90 NPL ratio continued its downward trend, reaching 4.1% in the quarter.
That's partly due to that typical seasonal decrease in early delinquencies we see in Q4.
And they're also benefiting from that strategic shift toward attracting lower-risk credit card customers and their growing focus on secured lending.
Right, those strategic decisions are having a positive impact.
Their 90-plus NPLs, which represent those longer-term delinquencies, also decreased, dropping to 7%.
It's another indication that their credit underwriting and risk management practices are working well.
They're also managing those renegotiated loans effectively. They often intervene before a loan even becomes 15 days overdue, which helps customers avoid falling further behind.
It's a proactive and customer-centric approach.
And their provision coverage level for their renegotiated portfolio is over 200%, which shows they're being prudent and responsible.
They're not just crossing their fingers and hoping for the best. They're planning for potential challenges.
Okay, let's move on to something that's been a real highlight for Nu. Secured lending in Brazil, particularly those payroll loans.
They're on fire in that segment. Their secured lending portfolio grew by an astonishing 615% year over year, hitting $1.4 billion. That's a significant portion of their total lending portfolio, about 23%.
It's a testament to their strategy and execution.
It is. They've made some smart moves, like partnering with 9 new collateral counterparties in the public sector, which has given them access to a much larger pool of potential borrowers.
So they're targeting government employees and public sector workers.
Exactly. And that move alone has expanded their addressable market for payroll loans to a whopping 70% of the segment.
That's incredible. Think about it. 12 million of their existing customers are now eligible for those payroll loans. Plus, you've got another 80 million potential borrowers out there for FGTS loans.
It's a massive market opportunity, and they're making the most of it. They've also made it even easier for customers to switch their loans to Nubank by improving their portability solution.
So they're attracting new borrowers and pulling in customers who already have loans with other institutions.
Exactly. As of December 2024, 16% of their INSS originations came from customers who ported their loans to Nubank, often refinancing at more favorable terms.
They're offering a better deal, and it's clearly resonating with customers.
Right, and their market share in those FTTS originations is another indicator of their success. It's over 30%.
Their fully digital model is a big part of that success.
Absolutely. It's allowing them to reach a large audience efficiently and cost-effectively.
They've also achieved product parity in secured lending, offering features like portability, top-ups, and refinancing for those public payroll loans in Brazil. They're on par with the big players.
They're not just keeping up, they're setting the pace.
And their integration with Brazil's armed forces, that was a strategic move.
It opened up a whole new segment of potential borrowers for them.
It's clear they have a plan to become a dominant force in the Brazilian secured lending market, and so far, they're executing it flawlessly.
They're doing a great job.
All right, let's turn our attention to their performance in Mexico, another crucial market for their growth ambitions.
They've already surpassed 10 million customers in Mexico, representing a remarkable 91% year-over-year increase. They're replicating their Brazilian success stories south of the border.
Their penetration in the Mexican market is impressive. They're now serving 12% of the country's adult population.
Their brand is gaining traction, and their product offerings are resonating with Mexican consumers.
And their deposits in Mexico have skyrocketed, surging by 438% from the previous year to $4.5 billion.
That's a huge vote of confidence from Mexican consumers. It shows they're building trust and establishing themselves as a reliable financial institution in the Mexican market.
Their credit card customer base in Mexico has also expanded significantly, growing by 70% to 5.6 million.
What's particularly impressive is that almost half of those new credit card customers didn't have a credit card before joining Numuser. They're bringing a whole new segment of the population into the formal financial system.
That's a real win for financial inclusion.
It is, and they're managing this growth responsibly. Their first payment default rate has improved by about 50% over the past 3 years, while their credit approval rates have actually gone up by 10%.
So they're striking that delicate balance between expanding access to credit and carefully managing risk.
They're doing a good job of walking that tightrope.
The strategic expansion of cash-in and cash-out access to over 30,000 contact points throughout Mexico also makes their services more convenient and accessible.
They're combining their digital strength with a physical presence, which is smart.
It seems they're effectively adapting their Brazilian playbook to the Mexican market.
They're demonstrating their ability to succeed in different environments.
Now, let's shift our focus to Colombia, where news performance has been exceptional.
Their deposits in Colombia have reached an impressive $1.3 billion, placing them among the top 5 financial institutions in Colombia based on demand deposits for individuals.
And they achieved that in just 2 quarters after launching their checking account.
It's a testament to their ability to scale quickly and effectively. They're clearly resonating with Colombian consumers.
Now, let's turn our attention to a critical aspect of their strategy: managing risk, particularly in the context of Brazil's current economic outlook.
Yeah, there are concerns about inflation and a potentially volatile economy, and those are valid concerns. But Nu's approach to managing risk is proactive and multifaceted. They're not downplaying those potential headwinds, but they're also not letting fear paralyze them.
They're taking a balanced approach.
Exactly. They're acknowledging the risks, but also taking steps to mitigate them.
Their decision to pause the aggressive expansion of their PIX financing product is a good example of that cautious approach.
PIX financing is a profitable product, but they're prioritizing the long-term health of their customer relationships and their brand reputation over short-term gains.
They're thinking strategically and focusing on the long game.
Absolutely.
Now let's take a closer look at Nu's credit card portfolio in Brazil.
Hmm.
We've already touched on their impressive growth, but there are a few interesting trends worth highlighting.
Yeah, their interest earning installments grew steadily each quarter, but the overall share of those installments actually decreased to 27%. It might seem a bit counterintuitive at first glance.
It does. Why would the share decrease, even though the installments themselves are growing?
It's primarily due to their decision to slow down the expansion of PIX financing, especially for certain risk segments. They're managing this product very carefully.
They want to make sure it doesn't negatively impact their overall credit card portfolio or their long-term customer relationship.
Exactly. They're monitoring its performance closely, making adjustments as needed. It's all about balance.
It's also remarkable that all of their secured lending originations are organic. They're not acquiring loan portfolios from other companies. They're building this part of their business from the ground up.
It's a testament to their brand strength and their ability to attract customers on their own.
And their strategic focus on FGTS-backed loans has been a big success.
More than 60% of their secured lending originations come from that product. They've clearly found a niche that works.
They've captured a market share exceeding 30% for new originations, which highlights the effectiveness of their digital distribution model.
They're reaching a wide audience directly, and that's a powerful advantage.
Now, let's talk about their funding strategy. Their total deposits for the quarter jumped to an impressive $28.9 billion, representing a 55% year-on-year increase. They're attracting deposits at a remarkable pace.
Their deposit strategy, particularly in Mexico and Colombia, is proving to be incredibly effective. They're offering competitive rates and a user-friendly digital experience that's appealing to customers.
Even after they reduced the spread over the interbank rate, they still managed to pull in $4.5 billion in deposits in Mexico, a four-fold increase from the previous year.
That's a clear sign that their brand is gaining traction and they're building trust with consumers.
And their performance in Colombia is equally impressive. They reached $1.3 billion in deposits just 2 quarters after launching their checking account there.
They're proving they can scale quickly and effectively in new markets.
All right, let's move on to their profitability metrics, starting with their net interest income. It surged by an impressive 57% year over year, hitting a record $1.7 billion.
It's a testament to their strong growth and their effective business model.
However, their net interest margin contracted by 70 basis points to 17.7%. There are a few factors contributing to that contraction.
Right. Their increasing focus on secured loans, which tend to have lower interest rates, is putting some downward pressure on their overall credit yields.
So it's a bit of a balancing act. They're prioritizing lower risk loans, even if it means slightly lower returns in the short term.
Exactly. And then there's the impact of their higher funding costs, driven by all that deposit growth in Mexico and Colombia. It's a natural consequence of expanding into new markets.
And we can't forget about the impact of currency fluctuations, which always add another layer of complexity.
Those are always a factor.
So how are they planning to address this margin compression going forward?
They're focusing on optimizing their balance sheet, and they believe that as those deposits in Mexico and Colombia normalize, their margins will improve.
They've also got that relatively low loan-to-deposit ratio, which gives them some room to enhance their efficiency and potentially boost their profitability even further.
They're always looking for ways to fine-tune their operations.
Now, let's turn our attention to their cost management strategy, which has been a key ingredient in their success. They've managed to maintain a remarkably low cost to serve per active customer of just 80 cents.
That's incredibly efficient, especially compared to traditional banks.
It gives them a real competitive advantage, allowing them to offer competitive products while still maintaining healthy margins.
Absolutely. But it's worth noting that on an FX neutral basis, that cost actually went up by 11% year over year.
Why is that?
It's primarily due to those typical seasonal spikes in data and processing usage that we usually see in the fourth quarter. It's not a sign of any systemic problem, just a temporary fluctuation.
So their underlying efficiency remains strong.
It does. And their average revenue per active customer, ARPAC, grew by an impressive 23% over the same period, more than offsetting those increased costs.
So their business model is designed to scale efficiently. And as they grow, their technology and automation help them manage those costs effectively.
Exactly. It's all about building a sustainable and scalable business.
Their gross profit performance also highlights their ability to balance growth with profitability. They achieved a gross profit of $1.4 billion this quarter, an 8% sequential increase, and a 44% jump from the previous year.
Both of those figures are adjusted for currency fluctuations, which shows the underlying strength of their business.
And their gross profit margins rebounded to 45.6%, close to 2023 levels, even with those higher funding costs they're facing in their newer markets.
It's a sign they're managing their growth effectively and maintaining healthy profitability margins.
Now let's touch on their non-performing loan trends again. Their 15 to 90 NPL ratio continued to improve, reaching 4.1% in the quarter.
That continued improvement is partly due to the normal seasonal decrease in early delinquencies that we see in Q4. But they're also benefiting from that strategic shift toward attracting lower-risk customers for credit cards and their increasing focus on secured lending.
So they're being more careful about who they lend to, and they're focusing more on those products that are inherently less risky.
Right, those strategic decisions are paying off.
Their 90-plus NPLs, those loans that have been delinquent for a longer period, also decreased, dropping to 7%.
It's a positive sign, indicating that their credit underwriting and risk management practices are effective.
Their proactive approach to those renegotiated loans, where they often step in before a loan even becomes 15 days overdue, is another example of their commitment to responsible lending.
It helps customers avoid falling further behind on their payments, and it reduces new risk.
It's a win-win approach.
It is. And their provision coverage level for those renegotiated loans is over 200%, which demonstrates their prudence.
Okay, let's move on to an area where Nu has really been excelling. Secured lending in Brazil, particularly with those payroll loans.
They're really making a name for themselves in that segment. Their secured lending portfolio grew by a remarkable 615% year over year, hitting $1.4 billion. It now represents a substantial 23% of their total lending portfolio.
Those are some impressive numbers.
They've been strategic about it, partnering with 9 new collateral counterparties in the public sector.
That gives them access to a much larger pool of potential borrowers.
Exactly. And it expands their addressable market for payroll loans to a whopping 70% of the whole segment.
Think about it. 12 million of their existing customers are now eligible for those payroll loans. Plus, there are another 80 million potential borrowers out there for FGTS loans. It's a huge opportunity.
It really is. And they're not just sitting back and waiting for those borrowers to come to them. They've also been improving their portability solution, making it easier for customers to switch their loans to Nubank.
So they're attracting new customers and pulling in existing borrowers from other institutions.
Exactly. As of December 2024, 16% of their INSS originations came from customers who ported their loans over to Nubank, often refinancing at better rates.
They're offering a better deal, and customers are noticing.
Right. And their market share in those FGTS originations is another sign of their success. It's over 30%.
Their fully digital distribution model is a key advantage for them in this space.
It allows them to reach a wide audience efficiently and cost-effectively.
They've also achieved product parity in secured lending, meaning they now offer the same features and benefits for those public payroll loans in Brazil that you would find from the bigger, more established players.
They're not just competing, they're leading the way.
And that integration with Brazil's armed forces, that was another strategic move, opening up a whole new segment of potential borrowers.
It was a smart expansion of their reach.
And it's clear they're on a mission to become a dominant force in the Brazilian secured lending market. And so far, their execution has been impressive.
They're firing on all cylinders.
Yeah. Let's shift gears now and talk about Nu's longer-term vision. They've laid out this interesting 3-act plan for their future.
Yeah, Act 1 is all about becoming the biggest, the most loved retail banking franchise in all of Latin America. They're aiming for dominance in their core markets.
It's ambitious, but given what we've seen so far, it doesn't seem impossible.
Right. And Act 2, that takes them beyond those traditional financial services. We're already seeing it with those ventures into marketplaces, travel, telecom. They want to be a part of every aspect of their customers' lives.
They're not just a bank, they want to be a partner.
Exactly. And Act 3, that's where things get really interesting, becoming a global AI-driven digital banking model, serving hundreds of millions of customers all over the world.
World domination, but for banking.
Exactly. That's the goal.
Yeah.
And they're already laying the groundwork, investing heavily in that multi-country technology platform. They're taking a measured approach, though, prioritizing their existing markets while they get ready for that global expansion.
They're not afraid to put money into innovation either. A good chunk of their workforce is dedicated to projects that aren't making money yet, but that could totally change the future of banking.
It's that long-term vision again, betting on innovation to set them apart.
It's really impressive to see their commitment to customer centricity, to innovation, to responsible growth. It's woven into everything they do.
They're not just building a business, they're building a movement. a movement to democratize financial services, to empower people all across Latin America and maybe even beyond.
It's a powerful story, and I'm really curious to see how it all plays out.
Me too.
All right, before we wrap things up, let's have a little fun with our This Is Not Financial Advice segment.
Okay.
We've talked a lot about New's incredible success building that loyal customer base, expanding their offerings beyond traditional banking.
Yeah, they're more than just a bank. They're like a lifestyle brand.
Exactly. So what if they took that idea even further and tapped into a market that's ripe for disruption? Dating apps.
Oh, that's interesting. They've already got a massive user base, a strong brand, and they really understand their customers' financial habits, their preferences.
Imagine a dating app where you could not only connect with potential partners, but also get insights into their financial health, their stability. It would be like a credit score for love.
It would definitely add a whole new layer to online dating. You could filter matches based on their financial responsibility, their spending habits, even their investment portfolio.
People are looking for compatibility in so many different ways. Why not financial compatibility?
Right. It could be huge. Of course, there would be some hurdles, privacy concerns, regulations to figure out.
Sure, but if they could make it work.
It would be a game changer. And it fits perfectly with their whole vision of building that financial ecosystem, right? Touching every part of their customers' lives.
It's definitely a bold idea. It would be fascinating to see if they actually try it.
Definitely.
And that wraps up our deep dive into New Holdings Q4 2024 earnings call. It's clear they're a company with a mission, and they're just getting started.
They're not just disrupting the financial industry, they're redefining it. It's a story of innovation, ambition, and a real focus on the customer.
Thanks for joining us. We'll be back soon with another deep dive into the world of business and finance.